consumers, I feel that we are not educated enough on how they work and how to take advantage of them, so that we are managing our money and our money is managing us. What's up, YouTube? Welcome to my channel. My name is Marsha Travis, and this is Money Mogul Marsha, a YouTube channel I started because I want to talk about business, finance, and fashion. Of course, those are the main focus in my life right now, and sharing this journey with you, giving you insight on my life, you sharing with me your experience is all I'm looking for. So if you like this content, definitely subscribe to my channel. Y'all join Money Moguls, become a money mogul, become, just a definition of bougie. That's what we are here. We're bougie. We really undefined, but we definitely bougie. Okay, and we all about just adding value to ourselves and self-fulfillment and reaching your full potential. So that's what this channel is all about. And I just hope to inspire individuals alike to go after what it is that they want and, take those risks, get your goals, all that good stuff. So today, this video is all about what is simple interest, okay? Now, a lot of people ask questions about loans, particularly car loans, okay? And I know a lot about car loans. When I say simple interest, I'm talking about a loan that you would take out for a vehicle. This does not apply for leased vehicles, okay? This only applies for a loan. If you take out a loan for a vehicle, then you can either have a fixed interest loan or a simple interest loan. Now, the difference between the two is one is kind of alternating month by month, while the other is always the same, hence the word fixed. So when you have fixed interest every month, let's say your car note is $350, okay? $50 of that is interest, goes to interest every month, and the remaining $300 go towards principal. And let's just say principal is like $10,000. So you're paying $350 a month on a loan, for let's just say 4 or 5 years. I didn't really do the math there, but 4 or 5 years. Now, every time you pay $350, $50 of that will go towards interest. It's already fixed. No matter what, every time you make a payment, $350, $50 goes to interest, the other goes to principal. The principal is the actual loan. The interest is what you're being charged to take out the loan. So with that, there's no surprises. Versus a simple interest loan. A simple interest loan is very different. Simple interest loan is pretty much saying you have that 10K. We're still going to take into account your APR rate, but instead of us fixing the price, we're going to base it upon your principal amount. Now, that's where it gets a little confusing because it took me a while to understand what simple interest is. But listen closely. So when you have your principal amount of $10,000, let's just say your APR rate is 5%. Let's just say 5%. Well, to pay interest on a simple interest loan, you start with the principal of $10,000, and then you have a finance charge. The finance charge is the amount of interest you expect to pay over those 4 years, okay? The finance charge, let's say it's $1,500. That's how much interest. You're paying $1,500 on a $10,000 loan. So altogether, by the end of this loan, you would have paid $11,500, okay? Let's just say you paid on time, you didn't miss anything, you always paid on your due date. It was just a perfect 4 years for you on your car note. And with that, every time you looked at your statement or your monthly bill, the amount of interest with that $350 changed. So let's just say your first payment, when you see your bill, $75 goes to interest, and the remaining, what would that be? I'm stuck right here. $350 minus 75. 275. So $275 goes towards the car note, okay? And then the other $75 goes towards interest. With that being said, that's it, okay? That's for that month, okay? From the period of you walking out of the dealership all the way to your first payment, that's how much interest has accrued, okay? Now you go to your second month, it's a little different. Instead of $75 going to interest, it's only $70 going to interest, and the remaining $280 goes towards what? Guess what? Principal, right? So with that being said, it changed. It wasn't fixed. Third month comes up, you get your statement. Now on this bill, let's just say $65 goes to interest, and the other portion, $285, goes towards principal. So you catch my drift? It's not a fixed amount, and the more you progress in the loan, the less you pay in interest per month. But with both loans, fixed and simple interest, you're still paying the same amount of interest. You know, it's just with the simple interest loan, I feel that you have an opportunity as a consumer to save yourself on some of that interest, because if you pay your loan off before the actual maturity date, guess what? You only pay that interest that accrued up until that point. So let's just say you pay your car note for 2 years, and then after 2 years, you buy the vehicle out. Okay, at that moment, whatever is outstanding in interest is what goes towards interest, and the rest goes to whatever is left on principal. Initially, as you pay on a simple interest loan, you start with a principal amount, and you have a target interest amount to pay. Once the principal goes down, the interest goes down. The more the principal goes down, the interest goes down. The amount of interest owed and the amount of the principal owed, but the amounts, it doesn't necessarily change. This has to be paid. This can kind of be played with. So as the loan gets smaller and smaller, the amount of interest you pay per month gets smaller and smaller. Okay? So with that, if you pay a day early, on your bill, you save yourself a day of interest. Okay? Thinking of it like that. So if we said every month, let's just say the first month, the daily interest charge, which is the per diem, the daily interest charge on your loan was $1.50 a day. So if you wanted to know how much interest accrued in a 30 days, or let's just say a month, you would multiply 30 times $1.50. Okay, $45 of interest. Okay, so $1.50 per day, that's $40 of interest, $45 of interest for the first month, for the first 30 days. Okay, now let's say you paid your bill a day early. Well, then you can minus off $1.50. For every day that you pay early, you minus that from the amount that goes to interest. But you have to be consistent. You can't pay early this month and then not pay, and then pay late another month. It counteracts you paying early that month. So that's another thing with a simple interest loan. You stay consistent. If you want to pay down your loan fast, great. Think of it as this: either you're going to pay principal payments, which means you're going to pay payments directly to the loan outside of your regular payment, or you're going to pay a little extra on your payment. Your car note's $350, you pay $400. Okay, that works as well. Or third option, you just pay early every month. So let's say you pay 15 days ahead of your due date. Okay, you pay 15 days ahead of your due date. If you multiply that by 4 years, approximately, you say 15 days times 12 times 4. That's how many days of interest you save. As your principal amount decreases, the daily interest charge decreases. So mid into your loan, it's gonna be, let's say, 75 cents a day for interest. Okay, so instead of paying $150 up front when you first started paying on loan, it's less. Okay, so it's like as principal gets lower, interest gets lower, daily interest, less interest paid over time. So if you pay off your loan before its maturity date, you save yourself whatever interest would have accrued those days. Okay, if you pay late on your loan, not only can you possibly incur a fee, but you can also incur additional interest, accrued interest, that it impacts the final payment of your loan, because the money that would have gone to principal is now going to interest. So it takes you a little longer to pay off the loan, because on the final payment, all of that backed up interest that was building up and accruing, well, now it's principal because you paid all the interest, but there's a lump sum of principal remaining. So you had a $350 loan, car note, but on your final payment you have to pay $600, and you're wondering why. It's because of accrued interest, additional interest that you accrued during the life of the loan. So if you extend your payments for any payment plans, if you're late, for whatever reason, any extra days in the loan elongates the loan and the amount that you pay. So that's pretty much my breakdown of what a simple interest loan is. It's not a textbook definition whatsoever. It's more so an explanation of how, if you are a consumer and you're looking at your statements and you're wondering, you have to have a simple interest loan, of course. If you're wondering why the amount is changing month to month, that would explain why. It's because your interest accrues daily. Okay, so definitely do some more research, understand what interest is, understand contracts before you go get a car, and know what it is that you're looking at. And that's all. Please like, comment, and share. Subscribe, because I definitely have more content coming. Some educational, some just vlogs, some just chatting with you all. So definitely subscribe. Thumbs up if you really enjoyed this video and you learned a lot. Hit me in the comments if I didn't make any sense, and let me know what questions you have so that I can explain further and offer some more details, because honestly, talking about loans, it's so much to cover. And give a thumbs up, subscribe, hit that bell icon, and we out.
Hi, Reggie.